Hi, my name is Jordan Wilson. Today we're going to take a quick overview of investment policy statements. Now, if you followed this series sequentially, we covered investment risk and we did a little bit on investment returns. Now, a few of the things that I talked about in those two areas, one, widows and orphans versus wolves of Wall Street. They probably have different technical knowledge, different financial situations, different risk tolerances, different investment objectives, probably different constraints on their time. So they tend to be different as investors. And because of that, the choice of investments and the strategies they employ should be different. So we're going to look at that in the investor profile section, who you are as an investor. And then we'll get back on the technical side into diversification, which, as we talked about with the investment risk, is probably the main way that investors manage or mitigate risk in a portfolio. And that was especially true when we looked at non-systematic risks, also known as diversifiable risk. You can diversify away that aspect of the risk. So we'll get back on the technical train with diversification after we take a brief detour into investor profiles. But first, just a quick overview of the investment policy statement in general. So what is it? It's a written document, or it should be. It defines the investor's planned investment strategy. It outlines portfolio construction and maintenance, and it's used as an evaluation tool. The first key component is the investor profile, and we're going to focus on that in a few subsequent sessions. But in brief, the investor profile is: who is the investor? Who are you as an investor? Are you a wolf of Wall Street? Are you a widow, an orphan, or more likely somewhere in between the two extremes? And who you are is sort of made up on what's your current financial situation? What expectations do you have going forward? What's your prospects? What's your growth potential? What are your financial objectives? What sort of constraints might be imposed upon you that may prevent you from achieving those objectives? What's your investment time horizon? What's your risk tolerance? Are you a widow that's overly concerned about losing capital? Or are you a younger person with a higher risk profile who wants to take on small cap South American equities or junior mining companies in Western Canada? What other constraints or objectives or personal circumstances impact you as an investor? Now that's important because your investor profile drives your target asset allocation. So if you don't know who you are as an investor and what you want to achieve, you will not be able to create an optimal target asset allocation. And I think this is the case, as I again talked about in the investment risk and the return side, is that most investors don't do the investor profile. And as a result, they kind of create a piecemeal, accidental portfolio. There's not a hard, fast, well thought out target asset allocation. It's simply somebody told you to buy Coca-Cola, someone told you to buy General Motors, someone told you to buy a Scotia McLeod mutual fund, and then you wake up and you suddenly got yourself a portfolio. But how do the pieces fit together? And that's a diversification issue. But it's also, what are your objectives? What are your constraints? How do we want to get from A to B? And maybe B is retirement or another financial objectives. The comment I put here is that studies show that 90%, roughly, the variability of portfolio returns is due to your asset allocation. Now, that's not your return itself. It's just the variability. And then when we talked investment risk, we talked variance. We talked volatility and how that drove the standard deviation calculation. And standard deviation is the risk measure in an investment. So again, investor profile drives your target asset allocation. Then once you've got the target asset allocation in place, you've got to construct your portfolio. And you've got to figure out your ongoing maintenance and management. Will I buy and hold? Will I actively trade? Will I dollar cost average or make lump sum purchases to build my portfolio? Will I employ tactical investing strategies or just adhere to an overall strategic plan? Will I try to time the market? These are sort of things in the ongoing construction and management phase that need to be addressed. Benchmarks, another component. Benchmarks need to be predetermined. So when you set up your initial plan and your target asset allocation and your portfolio plans, you identify predetermined benchmarks because they need to be relevant. If I'm investing in nothing but government bonds, I don't want to use the Dow Jones as a benchmark. It's apples and oranges. We want apples and apples, which tends to be another theme that I've harped on. Everything needs to be apples and apples. So if we're investing in large cap Canadian companies, the TSX may be a suitable benchmark. If we're investing in junior mining companies across Canada, then maybe the TSX isn't the best. Maybe we can find a smaller benchmark that works. And that's the same globally. If I'm investing in Australia, I don't want to use the NASDAQ as my comparable benchmark. So benchmarks are important. They're even more important if you outsource your investment management to a third party. You need ahead of time to agree on what is it that we're going to compare our actual results to. So both parties need to be in agreement on that. And again, benchmarks can also be as simple as when we looked at investment returns. Could be a real return. So you want to outdo inflation rate. You definitely want to outdo the risk-free rate, but that's a benchmark. And then, do you want to outdo your peer groups? So if you're RBC Bank, do you want to make sure that your performance is compared to the other major Canadian banks? CIBC, Royal, TD. So those are sort of considerations, and we looked at that in the investment return section. And then we move to reviews and remedial actions. What is the periodicity of the reviews? For most people, they'll be annual. But I also, from my side, I think you probably want to match your review periods to the risk of the portfolio. If I'm in nothing but 5-year term deposits or guaranteed investment certificates with a bank, a year might be too early. if I'm trading nothing but stock options, I can't sit around for an entire year to assess my portfolio. So there's a relationship, I think, between the periodicity of the review and the risk of the profile or risk of the portfolio. What kind of bandwidths are in place? You don't want to rebalance your portfolio because maybe your equities are 1% out of line with your target asset allocation. So most people will put in 5 to 10% bands. So if my target asset allocation for global equities is 40% and I'm at 38%, okay, we have a 35 to 45% band. I don't need to rebalance, because often a lot of that smaller variance is just short-term noise. So if I rebalance from 40 to 30 at 39 or 38 back to 40, there's a good chance that in my next review period, it's going to have gone the other way just because of normal short-term fluctuations. And every time I buy and sell, there's a cost involved. So you want to be careful on that. And then just how are we going to rebalance? If I'm at 40% in bonds and I only want 20%, do I sell 20% of the portfolio and reinvest it in equities or whatever the other allocation was? Do I just start buying more equities and not splitting it up going forward? So how do we do the rebalancing? And tax and cost are the two big drivers on that. And then the final point I'd like to make is twofold. Is one, you don't just review your portfolio. You should also review your investor profile. The investment policy statement is not a static document. And by that, what I mean is you don't create a IPS on January 1st, 2021, and then that's good for the next 20 years. Your life changes, and so too should your investment policy statement. It's a living document. So as part of your annual or periodic review process, look at the investor profile. Does it still fit you? If I created one when I'm 25 and single, I can't have the same investment patterns, perhaps, when I'm 30 with a wife, a child, and a large mortgage. So as my profile and my investment objectives and my constraints change, because that drives your target asset allocation, then you have to move to the back again and redo your investor profile, alter your TAA accordingly, and maybe even need to alter your benchmarks and other processes to make sure that they're in line with your current circumstances. And then the investment policy statement needs to be written. And I think the two key reasons for this are it maintains your focus. So we go through something like COVID recently. Stock market tumbles, people are panicking. But if you created a document that meets your financial objectives and your profile, and you do it when the world is good, that'll help you maintain that focus in your strategies and your investing patterns, even when there's these blips. And if you go back and look at 9/11, there was a huge investment crash after the terrorist attacks. But if you bought then or held on to your stocks and not bailed when everything crashed, you would have done much better than had you sold. Same 2016, the night of the Donald Trump US election. You have people like Paul Krugman saying in the New York Times. Sell, sell, sell. All these talking heads are, the markets are going to crash and never recover. Had you done that in 2016, it wouldn't have been a wise choice. So figure out what your plan of attack is while you're mentally sober and the world is okay, and then stick with it. And yes, I mean, there could be a permanent impact on things that you need to address, but don't just get caught up in the mass hysteria. And so a written investment policy statement will keep you on the straight and narrow. It also helps you provide some protection. So if you're using an investment advisor or a third-party asset manager, to have all these things understood and agreed upon between all parties ahead of time gives everyone clarity. So if I'm the advisor, I know exactly what my client wants and I've agreed to that. And it provides the client with some protection. So if I've handed my money off to Bernie Madoff or Warren Buffett to manage for me, they're clear on what my expectations are. So it gives me as the client some protection if they deviate. So if Bernie Madoff goes and does his Ponzi schemes, whoa, this isn't in line with what we agreed with. And then you get into issues such as fiduciary responsibility, maybe negligence. But again, it just keeps all parties clear as to what's being proposed and the path forward. So that's all I really wanted to say on an overview of investment policy statements. We're going to look at the investor profiles, and then we'll jump back into the technical side, because understanding diversification and compound returns and that kind of stuff is going to help make the target asset allocation discussion a lot easier to follow and a lot more relevant. So that's a quick overview on investment policy statements. Next time we'll look at investor profiles and try to figure out where you should be on the spectrum between wolves of Wall Street and the widows and orphans. Thank you for your time today. I hope you enjoyed this. Good luck with your investing.